Very good afternoon to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountants of India, I welcome you all in today's 150th CP program organized by AASB of ICI for this council year. As today's topic is very important, that is the commonly found errors during audit of financial statements. And in order to tackle this very important topic, we are having with us very eminent speaker, faculty CA Dr. Alok Kumar Garg. So on behalf of AASB of I extend my warm welcome to you, Alok sir, on this AASB platform to share your insights with all our participants. We are having with us Madam Achal Agarwal ji as a moderator of today's webinar. I also welcome Achal ji for this webinar organized by AASB of ICI. Welcome to you, ma'am. So let us start with the formal proceedings of the webinar. And I request Achal madam to please start the formal proceedings. Over to you, Achal madam,
Yes.
please.
Thank you so much, sir. Hello, everyone. Thanks for joining in and a very warm welcome to all of you. I am C. Anchal Agarwal, having 2.5 years of experience, and I'm pleased to get this opportunity of moderating this session. And I would like to thank AASP for giving me this opportunity. Considering the recent amendments in the financial reporting framework and increased oversight from the regulators, it is pertinent for each one of us to possess a thorough understanding of the relevant standards and disclosure requirement. So, we are pleased to organize this webinar on commonly found errors during the audit of financial statements. Our eminent speaker will be CA Dr. Alok Garg sir. Dr. Garg is a CA and CS having a long-standing industry experience of more than 16 years in the field of finance and accounts. He is currently working as an associate vice president as a head of financial reporting as well as internal audit with a large listed company. He has worked with Industar, HSBC Bank, ILFS in his earlier stints in the role of IFC, risk and control, and finance and accounts. Talking about his academic and professional qualifications, he is a qualified chartered accountant with All India Top 3 scorer in accountancy in year 2007. He is a qualified company secretary from ICSI in 2008. He is diploma in IFRS from ACCA London, certified INDAS and certified BRSR from ICAI. He has been awarded honorary doctorate in the field of financial reporting and accounting from American East Coast University, New York. His publications, associations, and deliberations experience are he is a renowned author with 4 comprehensive books in his credits. Recently launched third edition of his iconic book Treatise on Index and Treatise on Schedule 3, which is one of the largest and best-selling books in Index and Schedule 3. He is a prolific speaker, having delivered more than 800 lectures on accounting standards, CARO, Schedule 3, Ind AS, IFRS, IGAP, and auditing standards at various national and international platforms. He has been a special invitee to the prestigious Accounting Standard Board of ICAI. He has been awarded with National Education Leadership Award from Ramanujan College. He was the lead member for review of the accounting standards drafted by ICAI for Bhutan. He has immensely contributed in the development of study material for CA final students and education material for the members of ICAI. He has been contributed extensively in the academic and professional activities as esteemed institutions including ICAI, ICSI, and various universities. He has been consistently rated as the best faculty at ICAI and other forums. He is instrumental in giving back to the society and has mentored many students and professionals. So now I would request the participant to ask the question in the chat, if any, and I would now request CA Dr. Alok Garg sir to start the discussion.
Thank you, Anchalji, for the detailed introduction and AASB of ICI for giving this opportunity again. Especially Anchalji, who is always, giving opportunity on I say, more demanding topics. And that topic is also, the. So let me share my presentation. We have to talk about the commonly observed or commonly found errors during audit of financial statement. I hope my PPT is visible, Anilji.
Yes, sir. Yes, sir.
Okay. Okay. So let me start the discussion. So we are going to talk about the commonly found errors, right, during the audit of financial statements. During my next 1.5 hours, I'll try to touch upon that when a chartered accountant is conducting an audit, you know, in at that point of time when an auditor is conducting an audit, so what kind of errors is getting management? Of course, management is responsible audit is responsible for
Sir, I'm sorry to interrupt, but the voice is not audible correctly here.
is it okay, Achal?
Sir, actually, it is
Whether the
breaking.
voice is better now?
Yeah, now it's better. Yes.
Okay. Yeah. Yes. Yes. So management is responsible for preparation of financial statement and auditor is responsible for giving his opinion on the true and fairness of those financial statement, right? By auditing those financial statement. So auditor has to ensure two, three aspect. Number one, auditor has to ensure whether these financial statement are in compliance with accounting standards or Indian accounting standards, right? Number one. Number two, auditor has to conduct his audit in accordance with the auditing standards, right? These are the two standards which the auditor has to follow while conducting an audit of the financial statement. If talk about the management, management is largely responsible for the compliance of accounting standards. Auditor is responsible for the compliance of accounting as well as auditing standards. Okay. So we are going to discuss that what are the kind of errors which the auditor is getting, or what are the kind of the errors which regulators has seen while drafting or while finalizing a financial statement. We'll talk about those commonly found errors. We will touch upon few NFRA related observation where you will see that conducting audit of the auditors while conducting the post-mortem of the financial statement, audited financial statement, NFRA has, found some non-compliances in the audit of financial statement, some non-compliances in compliance with the Indian accounting standard, Schedule 3 of the Companies Act, auditing standard. We'll talk about those aspects as well during this next 1.5 hour, right? Friends, if I talk about the financial reporting regime in our country, in India, so we have three accounting standards. We have three kind of accounting standards today, right? When I talk about three accounting standard, we have Indian accounting standard, right? And these Indian accounting standards are largely applicable to listed companies and unlisted companies whose net worth is more than 250 crores. Okay. And these Indian accounting standards are not applicable to bank, not applicable to insurance companies. Okay. These Indian accounting standards are not applicable to non-corporate entities as well. Correct. Moving further, in addition to Indian accounting standard, we have accounting standards also, right? Accounting standards, which are notified under Companies AS Rules 2021. It is not 2006, it is 2021, right? These accounting standards are applicable to the corporates, to the private limited, to the limited entities on which Ind AS are not applicable. Right? The third one is accounting standard for non-corporate entities. Since non-corporate entities are like partnership firm, LLP, sole proprietorship firm, Hindu undivided family. So these are the non-corporate entities. And while drafting the books of accounts of non-corporate entities, still accounting standards are applicable. But these accounting standards are those which are issued by Institute of Chartered Accountants of India. Right? Friends, if you see, we have earlier, there are four class of non-corporate entities, right? Level 1, level 2, level 3, level 4, which is largely large, medium, small, and micro. Friends, in August 2024, I mean to say just 2-3 months back, Institute has revised that criteria and now there is only two classification. In non-corporate entities, now there is only two class of entities. Either it is a large entity or either it is a MSME entity, micro, small, and medium entity, right? So instead of four criteria, now we have only two classification criteria for non-corporate entities. If it is a large entity, entire accounting standards are applicable to that large entity. If it is a MSME entity, then there are some relaxations, some exemptions are there in case of MSME entity. For example, Accounting standard 3 is not applicable to MSME entity, right? So auditor needs to take these things into consideration that we are of a country where there are three kind of accounting standards. Number one, Indian accounting standard. Number two, accounting standard issued by ICAI. Number three, accounting standard issued by ICAI and accounting standard notified by Ministry of Corporate Affairs, right? So friends, there are three accounting standards. So it is important to see that which kind of accounting standard is applicable to which set of entities, and it is responsibility of the management as well as auditor so that they can apply the right set to the right entity. Okay. So this is a recent revision in case of the classification of the non-corporate entity. Friends, like we have three different kind of accounting standard in India for different set of entities, we have different format of financial statement also for different kind of entity. Division 1, Division 2, Division 3. We have Schedule 3 for the companies, right? While we have ICAI guidance note for non-corporate entity, but we have Schedule 3, which provides the format of the financial statement for companies, right? When I talk about companies, still, it is not only one format, it is again three format. Like we have three different set of accounting standard, we have three format of financial statement also, right? When I say three format of financial statement, it is classified as Division 1, Division 2, Division 3, right? Division 1 means, what is meant by Division 1? Division 1 is that financial statement format which is applicable to the companies which are following accounting standard notified by MCA, right? Under Companies AS Rules 2021. For example, there is a small private limited company. So that company needs to follow accounting standard, right? And on that company, Division 1 to Schedule 3 will be applicable. If I'll talk about a company like Reliance Industries Limited, it's a listed company. On that company, Ind AS are applicable. So if Ind AS are applicable on any company, in that case, Division 2 to Schedule 3 will be applicable. The third one, Division 3, is applicable to the NBFC companies where Ind AS are applicable. Friends, being an auditor, of course, I totally agree that financial statement is the responsibility of the management, but who is giving the opinion on the true and fairness, on the correctness? It is the auditor. So the compliance related responsibility is equally applicable to the auditors, right? Because auditors are the one who is validating, who is verifying, who is giving the opinion, who is telling to the stakeholders, yes, these are the right financial statement. So we have also seen that, there was a NBFC company on which accounting standards are applicable, and the audited financial statement, the format which was applied by the company is Division 3 to Schedule 3, which is not right. Division 3 to Schedule 3 format is only applicable to those NBFC companies on which Ind AS are applicable. So what about those NBFC companies? For example, ABC Finance Private Limited. If it is a NBFC company, but on this company accounting standard is applicable, then Division 1 to Schedule 3 will be applicable. Division 3 to Schedule 3 will not be applicable. Okay. Friends, then there is a CARO. So when the auditor is issuing its audit report, right? So we have seen that there are three set of accounting standard. There are three format of financial statement. Okay. Then for non-corporate, there is a ICI guidance note, which is not mandatory, but it is recommendatory, and it is good to, it is good to follow that, I would say. Then in addition to these three set of AS, Ind AS, three set of, Schedule 3 format, then there is a CARO related requirement. CARO is something when you are issuing your audit report. In that case, you have to follow the requirements of CARO 2020 as well. And this CARO 2020 typically in 2021, when this revised CARO become applicable, right? This revised CARO has 21 clauses in comparison to 16 clause in the last CARO. Right? So you have 21 clauses, and these 21 clauses are typically, I would say, very extensive, very detailed, and there is a very elaborate kind of requirement was there in this revised CARO. Okay. So friends, being an auditor, when you are issuing CARO and when you are applying CARO, it is important to check the applicability of CARO to the companies as well. For example, CARO 2020 is not applicable to the small companies, right? Small company which is defined as per the Companies Act, right? But if you have decided to follow CARO, right? For example, you're not aware about this exemption and you have decided to follow CARO 2020, you are decided to issue a report of CARO for a small company. In that case, if you have decided to follow, then you have to follow the requirements of CARO in the entirety, right? Second thing, when this CARO 2020, when this CARO 2020 was notified in the month of February 2021, subsequently in March 2021, 24th March 2021, Schedule 3 was also amended, right? And largely the amendment in Schedule 3 was in line with CARO. Okay. So friends, when an auditor is auditing the financial statement and when he is disclosing something in his audit report in the CARO, so he has to ensure that if that item is also related to Schedule 3, it has to be captured well in the notes to accounts of the financial statement. It was seen that, there was some disclosure in CARO. That disclosure was also required in Schedule 3, but there was no any disclosure in the notes to accounts in the financial statement regarding that kind of a disclosure. It was missing. Vice versa, there was some disclosure in the notes to accounts, but CARO report was silent on those kind of disclosures. For example, if I talk about working capital limits or loan, where the reconciliations has to be maintained, where the stock statement has to be filed with the banks. So CARO 2020 requires you to disclose, in addition to 5 crore of limits, whether the books of accounts which you have filed or the statement which you have filed with the bank, is it tallying or is it matching with your books of accounts or not, right? If the discrepancy is more than 10%, it has to be report out. Okay. So these kind of disclosure requirement was there in CARO as well as Schedule 3. So it was covered in one of the report, I mean to say, let's say CARO, but it was not disclosed in the Schedule 3 or vice versa. So since we are juggling and muggling into a lot of different kind of compliances, different kind of, we have variety of accounting standard, we have variety of format of financial statement, we have variety of items which needs to be captured in the financial statements. So that is why it is important when you are acting as an auditor and when you are doing a lot of audits, right? You have a small company, you have a private limited company, you have a listed company, you have a bank, you have an insurance company. So you are the auditor of multiple clients, and these multiple clients are multiple different entities, multiple legal entities, right? Where in one of the client accounting standard is applicable, in the other client Ind AS are applicable. In another client, you have to follow accounting standard issued by ICAI, right? So you are the one guy who is auditing different client, who is applying different set of principles, right? And at times what happened, so there is a lot of chances where our principle in one client will get mixed or overlapped with the another client, right? So we have to be very clear what is applicable to whom, right? So that we can avoid the commonly found error, or we can avoid the normal mistakes which can happen in audit of any financial statements, right? We will be talking more about the journey of non-compliances to non-compliance, right? Okay, NON to KNOWN. We will be talking about in line of these things. And friends, I want to start my discussion with one of the extracts from one of the report of NFRA. Okay, so there was a company, Man Industries India Limited. So NFRA decided to investigate the financial statement of this company, and they have issued a notice to the auditor that we want to investigate the financial statement of Man Industries India Limited for FY 16-17, right? While NFRA was constituted in 2018, and this financial statement, this company was picked for investigation after 4-5 years. Okay, after 4-5 years. So what happened, and you will be surprised to see what is written in this NFRA report. So I have just put the extract of that report. You know what is there. So I want to read for all of you, and you will be surprised to see that. Our review of the audit file submitted to NFRA shows several anomalies clearly evidencing Tempering by creation of additional document to mislead NFRA. Page number 11 to 14 of audit file contains the audit form letter dated this to this, requesting information, April 17, requesting information regarding statutory requirement for the period from 1st April 16 to 31st March 17, but the letter refers to the facts relating to a later period as shown as below. Friends, when GST was introduced in India? 1st July 2017, right, Anchal?
2017. Yes.
Yes, 1st July. To be precise, it was 1st July,
Right.
correct? So
Right.
when NFRA investigated these reports, normally what happens in the audit, we are doing post-mortem, right? For example, for 16-17, we are auditing the financial statement after March 2017. Okay. If it is a listed
Okay.
company, we have to, being an auditor, we have to complete our work till 31st of May. 60 days are given for a listed company. Okay. If it is a private limited company or unlisted company, 6-month period is there. Up to 30th September, you have to close your accounts, correct?
Right.
So when this review happened from NFRA somewhere in 2020-21, and they have asked for some documentation, they have asked for correspondences between the auditor and the auditee. You know, they were surprised to find that this audit firm has issued a letter asking some information relating to GST.
Okay.
Asking some information relating to GST. What is the financial year here? It is 2016-17. When GST will become applicable? 1st July 2017. So what does this
Right.
represent? What does it represent? Tempering, okay? Or the auditor was not aware about the applicability of the various laws to the entity, correct? Because this GST came on 1st July 2017, and this GSTR1, 3B, and sales as per books of accounts. So these all GST related returns, documents, challans are of course not applicable in FY 2016-17. Number two, you will again surprised to see that the another letter was issued to request some reconciliation and documents relating to lease rental paid as per Ind AS 116. Since this was a listed company, and on this company, Ind AS was applicable, right? And there is a standard Ind AS 116 accounting standard which takes care of lease accounting. Now, what happened? When Ind AS were notified in 2015, the applicable standard on leases was what? Ind AS 17, which takes care of lease accounting. Subsequently, wide MCA notification dated 30th March 2019. This old standard Ind AS 17 was deleted and it was superseded by Ind AS 116. The new standard was Ind AS 116. And Ind AS 116 was applicable from financial year 1920. And this financial statement is FY 16-17. Right. And the auditor has asked information relating to FY 1920. What does it mean? The investigation was started somewhere in 2020-21. At that time, the hot topic for leases was 116. The applicable standard in financial year 1920, the recent financial statement was 116. And the auditor has requested the information for 16-17 as per Ind AS 116, the standard which was not applicable, which was not notified at that point of time. MCA has notified in March 2019, right? So what does it mean? I don't want to comment more about this report and more about these two aspects where something which was demanded from the client and which was not applicable, which was not notified by the regulators of the country. How can someone demand that? But I want to say one thing, right? Not on particular on this report, but it is important and it is imperative to know what is applicable in which period of time. I think that is very, very, very important because the laws are changing regularly, the compliances are changing, right? The provisions are changing, and we are working in a very dynamic environment. So it is important to make a trail that what is applicable, which provision is applicable up to which period, and subsequently which provision is applicable, right? Even within the financial year, you will found that in the first half of the financial year, something different was applicable. In the later half of the financial statement, something different was applicable. I still remember that definition of small company was changed somewhere in September 2020 or 21, if my memory is right. So you have to be very meticulous as an auditor. When you are auditing the financial statement, you have to be very meticulous that Which law? Is it a MSME? Is it a Income Tax Act? Is it a Companies Act? Is it, accounting standard? Is it Ind AS, ICI guidance and circulars? So what is coming with the right provision, considering the right application? So the right rule is 2021 now, right? For the companies AS rules 2021, with the right provision, considering the right application. Correct. Moving on further. So I've just put a question because it's a virtual session so that people will be kind of responsive and interactive. So I've just put your one question. The financial statement of Dhoni Private Limited has been prepared in accordance with accounting standard notified under Companies AS Rules 2006. The accounts are prepared under historical cost convention and on accrual basis. I have found this kind of, basis of preparation, this kind of paragraph in the financial statement, right? In many companies, I have found that. Tell me, what is wrong in this paragraph?
Sir, accrual basis accounting is correct, but I'm not sure about the historical cost convention.
So, Anchal, everything is correct. The only thing is, if you're writing this paragraph and when you're referring companies accounting standard rules 2006, that is not right. In
Oh, yeah.
2021,
This is
so
the
there is a
older version.
company.
Yeah.
Yes, companies AS rules 2021 already came, and this companies AS rules 2021 has replaced companies AS rules 2026. There are some
Right.
smart auditors. You know what they write? They write with accounting standard notified under companies AS rule 2006 along with or as
Oh,
amended from time to time, as amended from time to time. But let me tell you, even that kind of statement is not correct. Why? Because this company's AS rules 2006 was not amended, it was deleted, and it was superseded by company's AS rules 2021. Correct? So
21.
you have to
Okay.
write the financial statement of XYZ Private Limited has been prepared in accordance with accounting standard notified under Companies AS Rules 2021. The accounts are prepared under historical cost convention and on accrual basis. So the right rule is 2021 now, right? For the companies who are following accounting standard. I'm talking about companies who are following accounting standard. Now I have changed my statement. So that was the last paragraph. Now this is the different paragraph. The financial statement of Messrs Dhoni and Sons has been prepared in accordance with accounting standards notified under Companies AS Rules 2021. The accounts are prepared under historical cost convention and on accrual basis. What is not right in this case?
Mm,
So if you see, in this
now,
case, it is, yes,
yes.
please.
As for my understanding, it is correct now.
Okay. But can you see what is the legal entity here? The legal entity is not private limited. The legal entity is Messrs
Oh,
Dhoni and
yeah.
Sons. It's a
Right.
non-corporate entity, right? So the same
Right.
audit firm, earlier this audit firm has a audit of Dhoni Private Limited, and this Dhoni Private Limited has a sister concern Dhoni and Sons, and the same auditor is there. Okay. So
Right.
this auditor is auditing the financial statement of both the entities. And the accountant of Dhoni and Dhoni Private Limited and Dhoni and Sons had just copy pasted this paragraph, changing the name of the legal entity. But it is not right because
Right.
it is a non-corporate entity. So one has
Right.
to write the financial statement of Mr. Dhoni and Sons has been prepared in accordance with accounting standard issued by Institute of Chartered Accountants of India, not notified under Companies AS rules, right? Because
Right.
Companies Act is not applicable on non-corporate entities. Correct. So we talked about this part that in we have three set of accounting standard: Ind AS, which is defined under companies Ind AS rules 2015, notified by MCA; accounting standard for corporates under companies AS rules 2021, notified by MCA; and accounting standard for non-corporate entities, which is issued by ICI under ICAI revised scheme. What is this ICAI revised scheme, friends? Recently, this classification criteria has been changed for non-corporate entities. The last version was 2021 version. So Council of the Institute came up with a guidance in March 2021 classifying the applicability of accounting standard to large, medium, small and micro entities. There were four kind of classification, but now we have two classifications, only large and MSME. On large entity, all the accounting standards are applicable. On MSME entity, few accounting standards are not applicable, and there are some relaxation and exemption in some clauses of other accounting standard. For example, when you are preparing the financial statement and when you are auditing the financial statement, which component is the difficult component? Let's say in balance sheet, profit and loss, cash flow, statement of changes in equity, and notes to accounts. There are 5 components. Now, which component is the complex component?
Cash flow statement, I
Cash flow
believe.
statement. Yes, statement of cash flows or cash flow statement,
Right.
right? So that is the most complex kind of a component. And hence, accounting standard 3 is not applicable to MSME non-corporate entity, right? So
Okay.
MSME and non-corporate entity pe accounting standard 3 is not applicable. Okay. So if you are the auditor of a MSME entity and that entity is not preparing the cash flow statement, that is okay. Okay. AS3 is not applicable. AS17 is not applicable for segment reporting. AS24 is not applicable for discontinuing operations. These 3 standards are completely not applicable to MSME entity, right? And with respect to few standards, there are some relaxations and there are some exemptions which are given in the accounting standard for MSME entities. Okay, like we have already discussed, there are, as far as presentation in the financial statement is concerned, there are 3 format of financial statement: division 1 to schedule 3, division 2 to schedule 3, division 3 to schedule 3, right? Friends, moving further, so whatever the challenges and problem you are facing, because one firm has a multiple client and all the clients are different status, right? So Mr. Gupta has below clients, okay? So he was pretty confused that what to refer and what not to refer, correct? For example, he has Ramlal and Sons, which is a partnership firm. So what is applicable to this partnership firm, AS or Ind AS? To this partnership firm, AS will be applicable, right?
Yes. Right.
Accounting standard will be applicable to this partnership firm, AS. And what is the format of financial statement which is
Division
applicable to this
1.
company? Not division
Division
1.
1.
No, it is what it is. It is a non-corporate entity. Division 1 comes
Okay.
under MCA. Division 1 comes under Schedule 3. Schedule 3 is the authority of MCA, right? So
Okay.
Ramlal and Sons can apply the ICI format of financial statement. So ICI has issued a format of the financial statement. ICI has issued a guidance on that. So Ramlal and Sons can apply that. Ramlal India Private Limited, now it is a corporate entity. Net worth is less than 250 crores. So
Then
if there is a
AS will be
private limited
applicable.
company, I mean unlisted company, of course, AS is applicable. Which AS? Accounting Standard on Companies AS Rules 2021. Then what is the format of financial statement? In
It
this
should
case,
be
division
first
1.
division. Yeah.
Division 1, right? So division 1 will be applicable here. So division 1. Shamlal India Private Limited, net worth is more than 250 crore. What is applicable here?
Ind
Ind AS
AS.
is applicable here, right? So Ind AS is applicable. And what is the format of financial statement? Division 2. This entity has to follow
Right.
division 2. What about Sohanlal Leasing Private Limited? It's a NBFC entity. Net worth is less than 250 crores. What is applicable?
Div-
Accounting standards are applicable here. AS.
right.
What is the format? Format कौन सा
Division
होगा?
3.
Division 1. Don't make this
1.
mistake. Division 3
Okay.
of Schedule 3 is only applicable for those NBFC companies who are following Ind AS, not AS, right?
Okay.
If AS
Okay.
is applicable, then Division 1 will be applicable here. Mohanlal Leasing Private Limited, NBFC company whose net worth is more than 250 crores, which is applicable,
Ind
AS or Ind
AS.
AS? Ind AS is
Ind
applicable in
AS.
this case. If Ind AS is applicable, then your Division 3 will be applicable here.
Right.
Okay. Rohanlal Bank Limited, this bank has to follow accounting standard. So there is no applicability of accounting Ind AS on bank and insurance company. Doesn't matter if it is a big bank, listed bank, doesn't matter. Even if it is a HDFC Bank Limited, Ind AS are not applicable. Why? Because RBI has deferred the applicability, postponed the applicability, and the date is not yet defined that from when Ind AS will be applicable to bank and insurance as of now. So on bank and
Right.
insurance company, what is applicable? AS is
AS.
applicable. What is the format? The format is they have to follow division 1
1.
updated with, in case of a bank, in case of a bank, as per RBI guidance, okay, as per the banking regulation, as per the RBI guidance, but they have to follow division 1 updated with, if there is any requirement of RBI, it has to be adhered. For insurance company, division 1 updated with the requirement from IRDA, Insurance Regulatory and Development Authority of India, right? So this is like that. Okay. So can you see, if a mediocre chartered accountant firm, if a mediocre auditor has 7 clients, can you see every client there is a different applicability, correct? So
Right.
a person who is signing these seven firms, these 7 legal entities, and it's not a big task. Okay, you can sign more than that. Only if you have 7 clients, one, two, three, four, five, six, seven. You can see on some AS by ICI, on some AS by MCA, then Ind AS. So all three standards, all three formats, different formats, right? So you have a mix of knowledge which is required, and applying the right knowledge at the right client at the right time is equally important. Okay.
Right.
Otherwise, one compliance may lead to a non-compliance to another one, right? Okay. Friends, I want to discuss another NFRA report, and this was relating to Anshu Clothing Limited. And friends, right now, NFRA is only in the ambit of NFRA. The audit firms are in the ambit of NFRA. They are issuing SOCOs, they are investigating the auditors, right? They are picking the accounts and they're investigating the auditors. Okay. And they are also punishing the auditors, not the management, right? So this is what NFRA is doing right now. So in case of Anshu Clothing Limited, in the matter of financial year 2015-16, and all these are postmortems, right? Postmortem after 5 year, after 6 year, after 3 year, after 4 years. In case of 15-16, you know, this NFRA information received by MCA regarding the irregularities in the financial statement by FRRB of ICI. Financial Reporting Review Board of ICI has found some irregularities in the financial statement. Okay. And they have given this information to MCA, right? Then MCA has given to NFRA, and NFRA initiated the investigation under Section 132 against the engagement partner, against the auditor, for professional misconduct in statutory audit. And let me tell you the kind of non-compliance. This is a big order, but I have just extracted, summarized the key matters. Okay. Non-provision of interest cost on borrowings from bank and NBFC. The company has taken a loan, right? And since the company is in default and the company is not paying the liability, not paying the loan, and it is an interest bearing loan, right? Since the company is not paying the loan, the company also not accrued the interest cost on the borrowings. Is it a right thing? Right? Until and unless the bank will not waive off the loan, until and unless the bank will not waive, can you accruing the liability, accruing the contractual obligations? Answer is no, right? So
Right.
it is a liability from the asset perspective, right? So expense and liability has to accrued on a conservative basis, on a prudent basis. But if it is an asset, for example, I have to recover some money from the debtors, okay? And let's talk about the bank, okay? So let's say bank has to recover this money from Anshu Clothing Limited. So that loan is an asset in the books of bank. In the books of this company, it is a liability. So when this company has defaulted, this loan become what? NPA, non-performing asset. So bank
Right.
will stop accruing the interest income, correct? If it become NPA, bank will not recognize the interest income. Why? Because of the principle of revenue recognition, you have to recognize revenue only when there is a certainty of the collection, correct?
Right.
अगर principal ही नहीं आ रहा है तो interest की certainty कैसे आएगी? How will you how will you establish the certainty of collection from interest? Okay. So bank, since it is an asset in the books of the bank, so bank is not accruing the income, that is okay. But a borrower whose liability is recorded in the books of account, how can he stop accruing the liability, the interest cost on this liability, interest cost on the loan in their books of accounts, right? So this was one of the non-compliances recorded by observed by NFRA. The company has not recognized loss in 62 lakhs, right? Whereas the reported loss is only 20 lakhs. Correct?
Right.
So which is non-compliances with the accounting rules and accounting provision, right? And the auditor has signed off this balance sheet, and auditor has not qualified on this aspect. Second aspect, the company has presented and the company has classified some trade receivable as unsecured, considered doubtful, right? In the balance sheet, somehow it is a unsecured and doubtful, but there was no any provision for doubtful debt, right? So if this company will provide this provision on the doubtful debt, so this doubtful receivable was 709 lakhs. What does it mean? It means the profit is inflated, or the loss is
Right. They have overvalued the
understated by
assets.
709 lakhs,
Right.
right? Correct. So your loss is understated. It should be more. Correct.
Right.
Wrong accounting of the deferred tax asset. Again, it's the management. Management will prepare the accounts as per their own whims and fancies. Correct. But it is the auditor who has to provide the opinion whether management has done all the compliances of the accounting standard, all the compliances of the laws and regulation which is applicable. Correct. So there was a deferred tax asset. This was a loss-making company, and the company has recognized a deferred tax asset, right? When you will recognize a deferred tax asset? When there is a virtual certainty and convincing
Right.
evidence, okay? When there is a virtual certainty and convincing evidence, then you have to recognize a deferred tax asset. And you can see the company has recognized a deferred tax asset of 9 lakhs, okay, and 64 lakhs for the losses pertaining to FY 15-16 and 14-15 respectively. However, there was no evidence indicating the sufficiency of taxable income in future to realize such DTA. Means there was a lack of virtual certainty and convincing evidence, and still the company has recognized and the auditor has not qualified on this aspect. Okay. Non-disclosure of the cost formula for measurement of the inventory, it is one of the compliance in accounting standard 2, and this cost formula for measurement of inventory was not defined, right? It has to be there.
Right.
Wrong amortization of expenses. The company reported preliminary expenses, listing expenses as non-current assets, which do not meet the criteria of non-current asset, as no future economic benefit are expected to flow. Friends, in many balance sheets, in many financial statements, you will find this preliminary expenses. Let me tell you, there is nothing called as a preliminary expenses. As per accounting standard, as per Ind AS, this preliminary expenses does not exist. This concept exists in income tax, right? I remember if there is a section called section 35D, where you get a 1/5 of deduction for preliminary expenses. It exists in the world of income tax. It does not exist in the world of accounting standard and Ind AS, right? So because this AS 26 has already changed, okay? So friends, this whenever these expenses has to incur, it has to be debited to the P&L right away in the financial statement, okay? Then there is a deferred revenue brand development expenditure. Okay, the company has done some expenditure and the company has capitalized that expenditure, and it was not satisfying the condition of accounting standard 26. Okay, so recognition of MAT credit entitlement presented as unamortized expenses, which is again not in compliance with accounting standard 22. There is a multiple non-compliances within the format of the financial statement. Multiple non-compliances, right? So period from which the company had been continuously defaulting on loans and interest is not indicated. Only name of the partnership firm invested are given in the financial statement. The other detail like name of partner, total capital, share of each partner is not given, right? Which is in non-compliance with the disclosure requirement of Schedule 3. Okay. Security deposit, advances recoverable in cash in kind. So there was a wrong presentation of these expenses. The auditor has not complied with the standard on auditing, like SA 230 relating to documentation, terms of audit engagements, non-compliances regarding the appointment of engagement quality control reviewer. It is a requirement. If you are the auditor of a listed company, you know, some other partner, in addition to the engagement partner, for example, we are the firm of, let's say, 5 partners. If I am the engagement partner, then my client financial statement has to be reviewed by some other partner of the firm who is known as a EQCR, engagement quality control reviewer. Okay, I am the engagement partner EP and he is the EQCR. Okay, and that was also missing. right? So on the record, the NFRA does not found that, this accounts has been also reviewed by the EQCR. There was action on the engagement partner. That partner was function, being a statutory auditor or internal auditor. Okay. Friends, NFRA also observed why I'm telling you these kind of stories. NFRA, so who is under the ambit of NFRA? Auditee or the auditor? It's the auditor, right?
Auditor, right?
Under the ambit of NFRA, it is the auditor, not audit, it is the auditor. Okay. And who is the auditor? Auditor is someone who is auditing the financial statement. What is the role of the auditor? The role of the auditor is to establish, is to provide an opinion that these financial statements are free from any material misstatements, right? This is the responsibility of the auditor. The responsibility of the auditor is to ensure, is to opine that these financial statements are in compliance with the accounting standards or Ind AS, whatever is applicable. Third, these financial statements are true and fair, are representing true and fair view, and are in compliance with all laws and regulations of the country financial statement. What could be those cases? For example, MSME Act. While doing a disclosure for MSME Act, right, whether it is a delay and delay is beyond appointed date, by appointed date, you have to see minimum MSME Act 2006 says that 40 when process. These kind of fines you have to see from MSME Act. For example, your client has given donation to see
Sir,
the
I'm really sorry to interrupt
yes.
again, but the voice is not right now. It's breaking.
Okay. Just a minute.
Yeah,
Just give me a minute.
sure.
Is it better now?
Yeah, it is better, kind of.
Is it okay now? Am I audible?
Yes, I think it would be fine.
Okay. Yes. So NFRA has also observed some non-compliances with the Companies Act 2013, right? For example, non-disclosure of purpose of loan to subsidiaries. The company has given the loan to subsidiaries, and the company has not disclosed the purpose of giving loan to its foreign subsidiaries in the Board of Directors report as required by Section 186. There are a lot of non-compliances relating to the format of the financial statement in Schedule 3. For example, the company has disclosed in the balance sheet some assets and liability as others, other non-current asset, other current asset, other non-current liabilities, other current liabilities. Schedule 3 requires to disclose the breakup of those others, right? What is my other non-current asset, non-current liabilities? What is my others current asset, current liabilities? So this is required to be disclosed in the notes to accounts under Schedule 3, right? But it was not disclosed. What is the other non-compliances which NFRA has observed? So this was typical. You know, there was a short-term borrowings and the company has not disclosed the short-term borrowings on the face of the balance sheet. And auditor has signed off that balance sheet also. And this short-term borrowing breakup is given in the notes to the financial statement. Right. So this is typical, I would say. DTA, deferred tax asset. So deferred tax asset and deferred tax liability will always be classified as non-current. But this deferred tax asset has been classified as current asset. And I can assume the scenario, for example, when you will recognize a deferred tax asset, for example, there is a loss in the company, okay, of 100 crores. The tax rate is 25%. So the company has recognized 25 crore of deferred tax asset, right? The auditor is auditing the financial statement, and this was for 31st March 2024. In the September 24, the company has got huge orders. And for the 6 months, because you have to see the subsequent period also at times. So for the 6 months, the company has got the huge orders. Okay. And the company knows that, whatever loss I have made in the last year, of course, my loss has already, wiped off. My loss is already set off in the first 6 months. And even I will have a huge profit in this year, right? So the management is saying to the auditor, see, my deferred tax asset, which you have recognized in the 31st March balance sheet, it will be reversed in the next year. Why? Because next year I'll have huge profit and this brought forward loss will be adjusted in the current year profits. Correct? And hence they have disclosed this deferred tax asset as a current asset. But standard says that even in Indian accounting standard, it is specifically written. Para 56 of India's one says that deferred tax asset or deferred tax liability.
May I have your attention, please? May I have your attention?
Okay, so there is a fire alarm which is there.
Oh,
Okay.
okay.
Yes. So talking about this deferred tax asset, it was disclosed as current asset. However, it was always required to be disclosed as a non-current asset. Okay. Cost of material consumed, purchase of stock in trade, changes in inventories. These items are required to be shown on the face of P&L. And while these has been shown in the notes to accounts, but in the P&L, the purchases were not coming, the cost of material consumed were not coming, the changes in inventories were not coming, right? So disclosure of loan was incomplete. If you have a borrowing, so that borrowing you have to disclose that borrowing, like rate of interest. Okay. Your borrowing from banks or financial institution, what was the sanction limit? So these disclosures were required in the
Right.
notes to accounts, which was
Subsequent
not there.
payment that we have to
Yes,
disclose.
subsequent payments. Okay. So classification of short-term borrowings and short-term loans and advances were not given, right? So you know that, for example, you have a long-term loan and you have EMIs around that long-term loan. For example, the loan was for 5-year period. So for the first 12 months, you have to classify it as a short-term borrowings, correct?
Right.
So that was a false alarm. Okay. Yes. So that was a thing. So the classification of short-term borrowings and short-term loans and advances were not given. And there was left in the audit of investments. For example, the company has done the investment in the related parties. And Section 177 of the Companies Act were not followed. So Section 177 of the Companies Act says that you have to take a prior approval in the audit committee or in the board for doing some related party investments. Okay. Okay, so Section 177 of the Companies Act were also not followed. Friends, now I have few points for the auditors. Key consideration to discuss. Okay. The first point we have discussed at length, clarity on applicability. Okay. Why? Because different set of AS and different format of FS are there. Voluntary application may lead to mandatory compliances. And I can tell you one of the practical scenario which I have seen. Okay. There was a MSME entity and the auditor has
Okay.
told there was a MSME entity, and on that MSME entity, accounting standard 3 was not applicable. I'm talking about non-corporate. I'm not talking about corporate. The auditor has told the client that please prepare cash flow statement also. Right? The auditor wants to say that I have done, some work, okay, because the balance sheet was very small, the P&L was very small. So he want to demonstrate the efforts and everything, and he told that please prepare cash flow statement. And since
Okay.
cash flow is one of the tedious tasks, and it was very difficult to, prepare the cash flow statement. So the cash flow statement was not matching. The cash flow statement was not matching. There was a difference of 10 crore. So there are three kind of activities: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activity. So what happened? Since the cash flow was not telling, the company has did one task and the company has opened the fourth activity, cash flow from other activity, put 10 crore, match cash flow and close the cash flow. Right.
Okay.
So auditor has also signed off. Then someone asked the question from the auditor that, this cash flow is not correct. Why? Because there are only three kind of activity, not fourth activity, cash flow from other activity. What is this 10 crore? Then auditor responded that, see, if I talk about from very kind of a fundamentally, AS3 is not applicable to this entity, right? So whatever we have prepared, whatever we have disclosed, it is a voluntary application, correct? So whether if I'm doing some voluntary application, is it on my whims and fancies? Is it on my whims and fancies?
No, I mean, even if we are voluntarily complying it, still we have to prepare the statement according to as per suggested, right? So we
You are
can't
right.
add, yeah.
You're right. So, for number one, if it is voluntary, just opt not to follow, I would say. But if you have opted to follow, then follow it in entirety. You cannot be a cherry picking, right? You cannot just be optional. You cannot say that I'll pick one part of it and not pick another part of it, right? Once you have voluntarily applied, once you have adopted it voluntarily, it has to be complete and it become your mandatory kind of a compliance, right? If you are presenting it, then it will become your mandatory kind of a compliance. You cannot be cherry picking. For example, in Ind AS, and of course, this Indian accounting standard, if I talk about, there are 39 Ind AS. And how many accounting standards are there? 27. While it is numbering AS1 to AS29, but AS6 and AS8 is not there. Okay. So in total, there are 27 accounting standards, but Ind AS are 39. If I compare the provision of accounting standard and provision of Ind AS, provision of Ind AS are way bigger, way complex than in accounting standard. In Ind AS roadmap, Ministry of Corporate Affairs has given an option of voluntary adoption, right? If any company, I'm not talking about non-corporate, I'm talking about company. If any company wants to apply Ind AS voluntarily, it can apply voluntarily. So, and para 16 of Ind AS 1 says that you have to give a statement of compliance. Management has to give a statement of compliance, and that kind of a statement of compliance has to be explicit and unreserved. Management has to tell that my financial statement is prepared in compliance in compliance with all the applicable accounting standards. Right. So if I'm doing a voluntary application, can I be optional in doing those Ind AS compliances? Am I allowed to
No.
be optional? Answer is no. No, I cannot be optional. For example, if I'm a company, I've opted to apply Ind AS, doesn't matter if it is voluntary application, right? But whatever Ind AS are applicable to me, I have to apply all the provisions of Ind AS on that company, right? So being an auditor, I have to see that what all Ind AS are applicable, and whatever Ind AS are applicable, all the provisions of those Ind AS has to be applied to that company as far as as far as four pillar of accounting are concerned. You know what is the four pillar of accounting? RMPD, recognition, measurement, presentation, disclosure. Auditor needs to
Right.
ensure that all the Ind AS provisions are applicable to the recognition, measurement, presentation, and disclosure principle of Ind AS. Okay, Caro. For example, on the small company, Caro is not applicable, but auditor has decided to present Caro because auditor was not aware. Then he is defending that, since Caro is not applicable, so how does it matter? I have decided not to do the compliance of 21 clause. I have decided to, pick the important clause, and I have just checked 7, 8 clauses and I have reported around that. So
Right.
is it okay? Answer is no.
No.
Doesn't matter if you have voluntary opted for giving a Caro report in your audit report. Still, if you have opted, then you have to do the entire compliance, 100% compliance of that Caro report for that client. Okay. So you can follow the research committee publication on commonly found error in reporting practices. This is one of the publication issued by research committee, and this research committee has given a lot of commonly found error in reporting practices. FRRB publications on commonly found non-compliances in financial statement you can follow, right? This will help you in your auditing the financial statement more effectively and more precisely, I would say. Preparation of financial statement, I would want to highlight a typical kind of example. Who is responsible for the preparation of the financial statement? While we
Management.
are saying that management is responsible for the preparation of the financial statement, while we used to say that, but if you see few wordings in the financial statement, you will you will be forced to believe that not management auditor is responsible for preparation of financial statement. And I can tell you, many audience, many listeners, when they will check the balance sheet of their client, they will found that yes, these lines are still appearing. Inventory, in the notes to accounts of inventory, you will find that inventory as valued and certified by the auditor, or right, or auditor is writing inventory as valued and certified by the management. What does it mean? The financial statement are the property of the management. Okay, right. Or in the notes to accounts, if it is written as valued and certified by the auditor, what does it mean? The auditor is not certifying, the auditor is not measuring, not valuing, the auditor is auditing, right? Daters.
Right.
So below the daters as per the list certified by the auditor or certified by the management. So why these lines are required? So as certified by the auditor is not the right line, okay? But why you have
Right.
to tell that it is certified by the management? Management has to certify the entire financial statement, right? Right from the top, right from the top of balance sheet till the last notes to accounts. It is the entire financial statement is the responsibility of the management. Why it is required to be written that it is certified by the management or it is certified by the auditor? Certified by the auditor is the wrong word. Okay,
Right.
right? It is not certified by the auditor, and it is not required to be written that certified by the management. Okay. Harmonious construction of guidance available. What does it mean? I'll give you a classic example here. If a company has opted for a revaluation of fixed assets, revaluation of property, plant, and equipment, when you look at Schedule 3 says that whenever a company is doing a revaluation, correct? And the revaluation difference, for example, prior to revaluation, the fixed asset was 110. After revaluation, it become 125. So before revaluation, it was 110, and after revaluation, it become 125. So difference is more than 10%. In that case, you have to give the reconciliation, you have to give the walk of the revaluation, right? What was the opening balance?
Okay.
What is the changes due to revaluation surplus? Whether revaluation has been done by the certified valuer or not? These kind of disclosures are required as per Schedule 3. Then, if you go to Accounting Standard 10 or Ind AS 16, which talks about property, plant, and equipment
PPE.
account, PPE. It says that whenever there's a revaluation, the company shall present following disclosures. In case of revaluation, the company shall present following disclosures: opening, revaluation, depreciation, closing, etc., etc. That's the entire walk. Now, a company has done a revaluation surplus, the impact was 7% only. And the company has not disclosed any disclosure relating to revaluation, and the auditor has also signed off the accounts. Is it right?
No.
It is not right. So this
Right.
requirement is there in accounting standard as well as Schedule 3. While Schedule 3 has given a threshold of 10%, but accounting standard has not given a threshold, right? So in that
Right.
case, the rule of harmonious construction needs to be applied, and all the disclosure of Schedule 3 has to be made in line with accounting standard, right? Since accounting standard requirement is to give the disclosure, so the company, when the company is not disclosing, considering it is less than 10%, it is not a right kind of thing. Okay. Accrual basis or cash basis. While everyone is writing, the financial statements have been prepared as per accrual basis of accounting. But when you actually look at the accounting policies, and when I'm discussing, and few people who are listening, they will appreciate and they will also agree to my discussion, that yes, when you read the accounting policy, you will feel like these accounting these financial statement are prepared on a cash basis, not accrual basis. Let me give you a classic example. You know, the revenue recognition standard says that, let me talk about AS9 or Ind AS 115. It says that revenue needs to be recognized to the extent certainty of collection is there. Correct? To the extent
Right.
certainty of collection is there. For example, you have delivered the services or goods to a you know what is written in accounting policy. In the accounting policy, it is written that revenue is recognized on the basis of receipt of cash. Revenue is
Yeah, that's
recognized
wrong.
when cash is received. So what does it mean? It is cash basis of accounting, not the accrual basis. Provision for gratuity. Provision for gratuity or gratuity expense needs to be taken into the accounts on the payment basis. What does it mean?
Right.
On the payment basis. It is a cash basis of accounting, which is not right. Right? Have you seen these kind of lines in the accounting policy? I see.
I do.
You have to say
I
that.
do have. Yeah, I do have seen revenue one, but not the gratuity one that you are saying. So
Yeah.
I might
But you
see
will
in the
find
near future.
in many accounts, you will find that the gratuity or leave has been recognized on the basis, right, which is not right.
Right.
Component of the financial statement, right? So talk about component of the financial statement in accounting standard framework. There is a balance sheet, profit and loss, the statement of cash is a cash flow statement to accounts. In Ind AS framework, there are five component. In accounting standard work, there are component. In framework, there are five, which profit and loss, statement of changes in equity, statement of cash flows, and notes to account. Okay, there are five component. Even NFRA observed that in few Indian and this statement of changes is supposed to be signed by the board of directors and the auditor, right? Even that okay. What is statement of changes in equity? It shows the movement in the share capital and the other equity, which is reserves and surplus, opening, addition, deletion, closing. So this entire walk has to be presented in the statement of changes in equity. Okay.
Right.
Current and non-current classification. There are issues in correct classification, right? Current and non-current. What is current? What is non-current, right? For example, if some assets are going to be realized within 12 months, expected to
Right.
be realized within 12 months within operating cycle, it is current. And beyond that,
Right.
any item which is not current is non-current. Correct? Same goes with the liability also. There are some set of rules for the liability. So any liability which is contractually payable within 12 months, right? If it is for trading, so within operating cycle, so it is current liability. Any liability which is not current is non-current liability, right? So there are a lot of issues in current and non-current classification, and auditor we should be very, I would say very conscious here. Why? Because this current non-current plays a very important role. Why? When you are taking a loan, the bank is also looking at various ratios: current ratio, liquid ratio, solvency ratio, long-term debt ratio, right? So normally
Right.
what happened is if someone has to improve his current ratio, instead of actually improving the current ratio, they have started shifting the current liability to non-current liability. I mean to say they have started disclosing the current liability to non-current liability. I think there is a important work which has to be done here, that whenever there is a classification between current and non-current, auditor has to check that why it is current and why it is non-current, right? Barring your deferred tax asset and liability, where deferred tax asset and liability should always be classified as non-current. Okay. So this is one of the
Right.
important aspect where one has to take note of it. Moving to the next part, here we are discussing the key considerations, right? And this is not the exhaustive list, this is the indicative list as per me, right? Not as per some guidance or some, other. Only AS or Ind AS or other regulations. When you are auditing, will you have a knowledge of the AS or Ind AS? Answer is no. You have to check the compliances of various other laws, for example, MSME. Like, for example, if there is a delay of MSME payment, you have to, accrue the interest over that. And so that is the bit of, MSME Act 2006. Then you have to make some disclosure around that. And whenever there's an interest on MSME payment, that interest is a disallowable expenditure. It is a permanent difference, correct?
Right.
So on that interest payment, since under Income Tax Act, it is a disallowable kind of a expenditure, you cannot recognize deferred tax also on that. You cannot recognize deferred tax. So if I talk about MSME payment, it is touching three aspects. Number one, interest on MSME payment. Interest on MSME payment, you are accruing as per MSME Act 2006 and you are disclosing as per MSME Act 2006. Number two, while making a current tax provision for tax, you are disallowing that MSME interest as per Income Tax Act. Number three, on that disallowance of MSME expenses, MSME interest expenses, you are not creating deferred tax. Why? As per the principle of accounting standard 22. सो सिंगल ट्रांजेक्शन लेकिन तीन जगह पे इम्पैक्ट है। एमएसएमई एक्ट का भी इम्पैक्ट है, इनकम टैक्स एक्ट का भी, और एएस 22 का भी है, इंडेस में इंडेस 12 का है, राइट? सो ऑडिटर should be well aware of the other regulation as well. For example, Companies Act. If you are giving a donation, then Section 182, which talks about 7.5% of average profit, right? You cannot do the political contribution. When I am saying donation, I mean to say political contribution. When you are making a political contribution, your political contribution should not exceed 7.5% of the average profit. You remember last time वो political contribution और electoral bonds को लेकर काफी ज्यादा
इशू हुआ था।
हंगामा हुआ था, right? And in the Supreme Court, there was a verdict that electoral bonds has to be cancelled, correct?
Right.
So 7.5% of average profit is coming out of Section 182 of Companies Act, and it also talks about the separate disclosure, separate presentation of such political contribution. Correct. Talking about managerial remuneration, again, you have to see the compliance of Section 197, 198. Talking about CSR, you have to check the compliance of Section 135, and you have to do the CSR calculation. The limit of CSR calculation, when you are picking the net profit, you have to check the net profit in compliance with Section 197, 198. Correct? So you should aware about those provisions of Companies Act. Talking about net worth, right? For example, you are doing some ODI investment, overseas direct investment, right? So there is a FEMA guideline which says that you cannot do your ODI investment for more than 4 times of your net worth. Okay. So let's say if you have to compute the net worth, again, you have to go back to the Companies Act and check what is the meaning of net worth. So Section 2, subsection 57 or clause 57 talks about the net worth definition. You have to check from that. For example, the company has decided to distribute the dividend. You have to check the compliance of Section 123. You have to see the meaning of free reserves as per Section 2, subsection 43. Right. If the company has done some related party transaction, while you will follow accounting standard 18 or Ind AS 24 for the disclosures, but you have to check the compliance documents before that, approval documents as per Section 177, 188, correct? If it is a listed company, you have to check the provisions of SEBI LODR also, correct?
Right.
Comparative. And one has done a classic things here in comparative, right? So there is a one page of balance sheet, there is a one page of P&L, one page of cash flow. So in all these things, they have given the comparative. But in notes to accounts, even in the notes to accounts, you can see, for example, in the notes to accounts, there is a breakup of, let's say, there is a breakup of, for example, so there was there current year and comparative year, and there are some narrative which is below the table, correct? In the narrative, we
Right.
used to write that this includes rupees XXX for the current year, and within bracket we are writing the previous year number also, correct?
Right.
हम लोग लिखते हैं ना नोट्स टू अकाउंट्स में, बहुत जगह पे जो सेंटेंस के अंदर हमारा एक नंबर हम देते हैं, दिस इंक्लूड्स दिस अमाउंट इन दिस ईयर. फॉर एग्जांपल इंटरेस्ट इनकम इंक्लूड्स, हम नीचे लिखते हैं इंक्लूड्स rupees 50,000 from banks, for example. So within bracket we have to write the same similar comparative number for the last year also, but in many balance sheets this was missing. While टेबल
Right.
में तो दिया है comparative, but जो narrative है, जो sentence है, in the sentence that comparative number was missing. Events only till reporting date or till financial statement signing date.
Till financial statement signing date, that would be
The
subsequent
audit,
events.
yes, the auditor roles and responsibility is till financial statement signing date. For example,
Right.
the company has created a provision for doubtful debt in the 31st March balance sheet. Right? The company was thinking that, this money is dicey and probably I'll not able to receive this money, and the company has created a provision of rupees 50 crore on the doubtful debt. Before balance sheet signing, the company has got the entire amount from the customer, from the debtor. So whether that provision which the company has created, estimating that company will not be able to receive the money and company has got the money, this provision still hold, or the company has provision considering it as an adjusting event.
It should be considered as an adjusting event.
Now,
Sir, your voice is again breaking.
is it better now, madam?
Yes.
Okay. Second example, let's say on 30th March, the company's health was very sound, right? Good profitability, good balance sheet, lower debt. But in the month of June, it was a private limited company. In the month of June, the government has come up with an announcement to ban the product which is manufactured by that company, right? And the company was dealing into one single product, and government has decided to ban this product in the next 6 months. The government has come up with the notification. On 31st March, everything was great. It was just like a blue water. But in the month of June, the situation becomes very muddy, right? So now, when the government has come up with this kind of announcement, this will impact on the going concern of this entity, right? This
Right.
entity will not be able to run the business in the next 12 months from the reporting date, right?
Right.
So what will happen in that case? Whether financial statement has to be prepared, audited, signed on the going concern, or the going concern assumption is defeated here.
The going
The
concern
going
assumption is
concern
defeated.
is defeated here, right? The financial
Right.
statement should not be appeared on a going concern. So, my dear friends, there is a myth that you have to, if you are auditing a financial statement of 23-24, then you are only responsible for up to 31st March 24. It is a myth. You are responsible for till the time you are signing your financial statement, right? Being an auditor.
Right.
And that is why you have to ask for critical information. You have to ask for critical updates. And many times, even the auditors are asking for the trial balance up to the date of signing. You can take a window, for example, 5 days before signing, for example, because आप sign कर रहे हो उस time तक तो नहीं देख सकते ना. You have to take a window,
Right.
of course, right? Disclosure, remedy or information. Now, I still remember one of the classic case that, the management wants to inflate the numbers of profitability, and they told the auditor that, I want to apply a LIFO method of inventory valuation. Okay. So what is a LIFO method of inventory valuation? Last in, first out. It
It's
is not
last in,
allowed under
first out.
accounting standard, or it is not allowed under Ind AS. It is prohibited. Okay. It
Right.
is allowed in US GAAP, but it is not allowed in AS, Ind AS, or IFRS. So what happened in that case? When this LIFO method, okay, so auditor told that, LIFO method is not allowed as per accounting standard or Ind AS. The management told that, okay, let me apply the LIFO method and I'll put a note in the notes to accounts that I have applied LIFO. Okay. So standard says that disclosure, a disclosure of a wrong accounting policy is not a remedy of application of accounting policy, right? डिस्क्लोजर इज जस्ट लाइक एन इंफॉर्मेशन. इट इज नॉट अ रेमेडी कि ठीक है आपने गलत अकाउंटिंग पॉलिसी अप्लाई कर दी, उसका एक डिस्क्लोजर दे दो, काम खत्म हो गया. बीइंग एन ऑडिटर, यू हैव टू क्वालिफाई. You have to
Right.
qualify, highlighting the impact that if the company would have done the right accounting, probably FIFO weighted average, what would have been the value of inventory and what would have been the impact on the P&L, on the profitability, on the bottom line. So the auditor has to highlight, and the auditor has to qualify in compliance in considering it is a non-compliance of AS2 or Ind AS2. Okay, so it is an information. Schedule 3 disclosure rounding off. So prior to March 2021, prior to March 2021, what happened? The rounding off was not mandatory for Division 1 schedule. Rounding was mandatory for Ind AS client. It was for account income. But 2020, this listing of firms is applicable for all the company, even for a compliant company. The threshold round, right? And threshold of rounding off is depending on the total income, not on the turnover. So in many cases, there were non-compliances where the government has first of all took the turnover. The difference between turnover and total income. Total income is equal to revenue from operations plus other, right? And the rounding thresholds are, what is my rounding of thresholds? My rounding of thresholds are, if my total income is up to 100 crore, I can round off the numbers in hundreds, thousands, thousands, lakhs, and millions. Okay, in millions. If my total income is more than 100 crore or more, then I have to round off either in crores, millions, lakhs, or thousands. Okay, in hundreds it is not allowed. So number one, in few cases the rounding off was not there. Number two, in few cases the rounding off was there, but right parameter was not there, but the right metric was not there. The right, rounding off was not there. So number three, in few cases the rounding off was picked as per turnover, because earlier the requirement was for turnover, but now the requirement is for total income. So one has to be very clear that how to do the rounding off in compliance with Schedule 3. Trade payables and receivables aging, right? While it is a requirement of Schedule 3, in case of trade payable, you have to disclose what is your trade payable which are not due and due after year, 2 to 3. In case of receivable, it is due and due within 6 months, 6 to 12 months, 1 to 2 year, 2 to 3 year, and more than 3 years. This is the requirement of trade receivable. Now, friends, the question is, for example, there was, and again, the breakup is required between 100, right? But
Right.
you have liability. You are not paying to your vendor, paying to the vendor. Okay, was disputed, and the dispute going in the court of. So it is disputed since last 7 years. So it is coming into the window of more than 3 years. So that is okay. Why? Because being an auditor, you will have to check the document. Okay, the litigation is going on, and hence this liability has not been settled. But there is a liability and which is undisputed. There is a liability which is undisputed. And this company is paying to everybody, but not paying to that creator. What does it mean? It means there is some kind of fishy transaction. It means,
Right.
and I'm not saying always it is a fishy transaction. I'll not say that always it is a fishy transaction. But the point is, being an auditor, your roles and responsibility will get increased. That if a company is a cash-rich company, the company is settling the liability within the due dates. Why this company is not paying to this party for last 6, 7 years? There is no dispute. So in that case, you have to check the documents properly, and probably that liability has to be back. Okay. Number one, liability has to be given back. Is it actually payable or is it not actually payable? Or if the company is saying it is actually payable, then you have to roll out the balance confirmation. You have to have a balance confirmation around that. It should be external confirmations, right?
Right.
CSR provisioning and disclosure, we talked about. The political contribution or electoral bonds, we talked about. Actuarial valuation is again important and mandatory. If in India, it is mandatory. In accounting standard, of course, it is mandatory. If more than 50 employees are there, you have to do the actuarial valuation, correct? Then, friends, just a minute. Then interest accrual on MSME. Now we have a section 43BH of Income Tax Act, I believe, right? I believe
Right.
that section is right as per my knowledge. So interest accrual on MSME is important. So being an auditor, it is your responsibility to check the interest accrual, whether the company has done on MSME or not. Impairment assessment now takes a, I would say, a very important seat. Before COVID, no one was thinking about impairment assessment, but this impairment assessment again has become a very important aspect where you need to check whether your carrying value of assets are more than the recoverable amount. If it is more than the recoverable amount, you have to do the impairment. Okay. So there are a lot of impairment indicator. You have to see that. For example, if the market capitalization is getting down, if the interest rate is getting high, so these are the circumstances. If the company is incurring regular losses, These are the circumstances where you need to check the impairment assessment. You need to ask for the value in use. You need to ask for the cash flows, projections, right? From the management, and you need to check those projections. You have to do the sensitivity, and you have to check the recoverable value. Audit fee, whether audit fee is a provision or expense payable. Provision is a liability of uncertain timing or amount. Whether in case of audit fee, is it a liability of uncertain timing or is it a liability of uncertain amount? While in our
Liability of
normal
yeah.
while in our normal बोलचाल की भाषा we talk it as a audit fee का provision कर लो, but audit fee is not a provision. It is something which is
Yes.
approved by the board and audit committee, right? So audit fee is
Yes.
something which is already approved. ऑडिट कमिटी ऑडिट फी में ऐसा नहीं होता ना कि अगर आपका प्रॉफिट 100 करोड़ होगा तो मेरी फीस 10 करोड़ होगी, अगर आपका प्रॉफिट 50 करोड़ होगा तो मेरी फी 5 करोड़ होगी, ऐसा तो नहीं होता. इट इज नॉट वेरिएबल.
No.
Audit
Right.
fee is kind of a fixed amount which is approved. Okay. So audit fee is an expense payable. It is not a provision. It is not like a provision for gratuity, provision for leave encashment, provision for asset retirement obligation. Right? It is not like that. Forex restatement. Friends, if your client or the company or the entity is dealing into the forex, I mean to say dealing into the forex means the company is into the forex transactions. Okay, the company has a lot of import and export, for example. So as per the provisions of accounting standard, the balance sheet items, and in the balance sheet item, the monetary item has to be restated, and the non-monetary items are not required to be restated, correct? For example, if it is a trade receivable, it is going to be restated. For example, if it is a property, plant and equipment, I have a, let's say, building in America and I'm an Indian company. So this building is my property, plant and equipment, which is at a historical cost, okay? Which is at a historical rate. This building is not going to be restated. But if it is a trade receivable, it is going to be restated. If it is an inventory, it is a non-monetary asset. But if it is a trade receivable, it is a monetary asset. So number one, to apply the right principle of forex restatement as per AS 11 or Ind AS 21, you have to be very clear on what is my monetary item and what is my non-monetary item, and your accounting policy should be very clear, right? So it is not a simple rule कि ठीक है बैलेंस शीट का आइटम है उसको क्या करो, जो भी क्लोजिंग रेट आ रहा है उसमें मल्टीप्लाई कर दो, डिफरेंस को ले जाओ unrealized or realized unrealized forex के अंदर, right? It is not like that. It is not like that. Okay. First, you need to have a correct classification between the monetary and non-monetary item. Then monetary item needs to be restated and non-monetary item does not require a restatement. Confirmed penalty provision or interest provision for non-compliances. The company has to file a particular return with the government authority. And the due date was 31st January. Up to 31st March, the company has not filed that return. The penalty was 1,000 rupees every day. Okay. For the period of delay, the penalty was 1,000 rupees. While till 31st March or till the date of signing of the financial statement, the government has not raised any notice. The regulator has not raised any notice for the penalty. But do we need to accrue this penalty on this non-filing of
Yes.
return? Of course, yes. So the confirmed penalty provision needs to be taken, or interest provision for non-compliances that has to be taken. But for example, the income tax case was going on. The AO has disallowed some amount, and the AO has also issued a notice of section 271 1C, that penalty notice, right? For which the company has went into the litigation again. So that kind of a penalty provision does not needs to be taken. But if it is a confirmed penalty provision, that needs to be taken in the books of accounts. Okay. Fair value assessments. Auditor has to be very mindful about this fair value assessment. Like for investment property, as per Ind AS 40, this investment property has to be this for this investment property, land and building, the valuation, the revaluation or this fair valuation has to be done by the certified valuer. So the auditor need to check the report of the valuation report of this valuer. The auditor has to see the outliers. The auditor has to talk to the valuer, and he has to ensure that, the work done by the other experts are in line with the requirements. Capitalization for the purpose of depreciation and amortization, right? For example, if someone is capitalizing his factory, if a client is capitalizing a factory, right? So what is the benefit of capitalization? In the benefit of capitalization is, for example, if you have capitalized your asset on 28th of March, you will get a, you will get a 50% rate of depreciation in income tax act. Correct? वो होता है ना, more than 182
Right.
days to. So you will get a 50% rate of depreciation benefit in income tax just by capitalizing 2 days before the end of the year.
Right.
Correct? While in Companies Act, it is pro rata, it is only for 2 days. So again, if a company is capitalizing, which is very near to the boundary of the financial year, I'm not saying it is right, wrong or right. I would say this is an auditor responsibility to check whether the asset is available for use, because the concept under Companies Act is available for use. Under accounting standard in
Right.
days, if that asset is available for use, it has to be capitalized. Okay.
Capitalize.
Confirmations, external or internal confirmations, for example, debtors, creditors, lawyers, okay, treasury, which is bank, FDs. So these kind of external confirmations are important, which has to go to the auditors directly. Okay. Internal confirmations can be done by the for the estimates which have been internally, weighted by the management and internally generated within the management. Audit trail. This requirement was there since last year. Okay. Again, auditor has to see the requirement of the audit trail from this year. There is another requirement from, the whether the trail of transaction is there. The another requirement is preservation of the audit trail. Now the auditor will come and check whether the last year transactions audit trail is preserved or not, right? Like there is a requirement of preservation of accounting records for 8 years. The preservation of audit trail requirement is also there for 8 years. Friends, if the company is following a accounting policy, if the company is following Ind AS, while in our notes to accounts, we are writing significant accounting policies, right? But in Ind AS, from the last year, Ind AS 8 was revised, Ind AS 1 was revised. Now it says that instead of significant accounting policy, it has to be material accounting policy. It has to be material accounting policy, right? So the word is material accounting policy, not the significant accounting policy. The difference between material accounting policy and significant accounting policy is, in material accounting policy, it has to be material and more significant to the company's business, right? Whatever is given in the accounting standard or index, it should not be just be copy pasted, but you have to give the accounting policy more from the perspective of the company's business. So I believe, and in my view, these are the considerations, these are few aspects which I believe we need to take into the cognizance, we need to understand, we need to dwell more when we are auditing the financial statements. Correct? So this was the my kind of a, takeaway. This is kind of a takeaway for you guys from my side. So in my presentation, I'll share this presentation to the committee. I have covered the Financial Reporting Review Board and Research Committee, commonly found errors in the AS or Ind AS. So that I have covered already. So I'm not going to read these kind of non-compliances. I have covered few non-compliances already. I'm not going to read. And so with this, I'm concluding. Let me go to your favorite slide, which is thank you slide. I'm just in the process of getting into the thank you slide. So thank you, friends. My number is 999991543, and my email ID is cialokgarg@gmail.com. You can connect me on LinkedIn as well if you have any query or you want to discuss anything. So thank you so much. And over to you, Achal ji and Anuj
Thank you
ji.
so much, sir. Thank you so much, sir, for this experience. I mean, it was really great and extremely knowledgeable session that I have configured here. So thank you so much. But I do have two, three questions to ask if you allow me.
Yes, please.
Sir, okay. So first question is it necessary that all the errors identified by us, like identified by the auditor during the audit, needs to be corrected by the management?
Yes. So fundamentally speaking, answer is yes. But again, the accounting standards gives you the cushion of materiality, right? For example, a
Right,
company which is having a sheer size of, I would say, thousands of crores, and the
right,
company, and there was an error of, let's say, 40 lakh or 50 lakh, right? And even the company is reporting its number into crores, right? Company number भी crores में report करती है. There
right,
was an error of 40 lakh means in terms of the unit of measurement, so it comes out as a zero point 0.4, right? If the company is reporting into crores. So this
right,
number is not material and hence it is not required to, get this corrected within that year. Even though if the company is not getting corrected or auditor is not getting corrected within that year, even that is okay from the purpose of compliance of accounting standards, right? You have to see if it is material, of course, it has to be corrected. You need to check the
Okay.
methodology.
And sir, even if it is material and we have discussed it with the management, but still the management is not, agreeing to correct it, then what are the
In that
reporting
case,
implications?
you have to qualify your audit report, I believe, and you have to communicate this to the audit committee and board that, this is the identified material error which is not corrected by the company. Okay.
Okay. And so just last question, like I have come across external confirmation like that we do on a daily basis on our client, but I'm not really very aware about the internal confirmations. So if you can lighten more upon that, so it would be really great.
So basically, there are two ways of confirmation, external and
Yeah.
internal. Internal is more like a letter of representation, right? Where management is writing and giving comfort to the auditor. Correct.
Okay.
For example, at
Okay.
many times, the auditors are saying that ये आप management से mail पे ले लो. Correct.
Hmm.
That how
Hmm.
they have done this calculation, right? So what kind of
Oh.
assumptions they have given. For example, uh, for warranty provision, I took a provision of 10%, right? So nobody can
Okay.
give you confirmation externally for the 10% because it is management who has taken the 10% of warranty expenses. But वो मैंने
Right.
10% कैसे लिया? So I have took assumption and I have, gather some data facts for taking that assumption. For example, I told that, 90% in my as per my past precedent, as per history, it is coming out at 7 to 8%. And then I have also told that, my quality of the product is also getting down. So I have taken a sensitivity of 2-3%. Right? So I
Right.
have some, nut and bolts. I have some assumptions. I have collated the assumption and took the impact of 10%. So who will take that?
Okay.
Confirmation? So what auditor will do? I am a finance guy. So let's say this is coming from the engineering, or this is coming from, for example, my operational department. So they will take the confirmation from my operational head, my chief operating officer. Okay. Though, so
Okay.
they will dialogue with them. They will get the confirmation from them. So this is kind of a internal confirmations.
Okay. Got it.
But
Yeah.
of course,
That.
for
Yeah.
trade people, trade receivable, cash and bank, of course, you will not have an internal confirmation. You will have external confirmation.
External. Yeah. Right.
Yeah.
Okay. Thank you so much, sir. Thank you so much.
Any other question, Achal ma'am, at your WhatsApp? Please check. Members have sent more questions.
Yeah. Just a minute.
And chat box, please check more questions.
Yeah. There are questions. Let me just. So, shall I speak here? So, the first question is companies in losses for the past 12 years, deferred tax asset is recognized only on depreciation. Difference and no deferred tax asset on losses is recognized. Company can continue to carry forward the deferred tax asset. This is the question.
See, the question is while, there is a limit to the carry forward losses. I believe the limit is 8 years, correct? You can carry forward losses up to 8 years and you can set it off. For the unabsorbed depreciation, there is no limit. Okay. So again, for recognition of deferred tax asset, the bigger question is, do you have a virtual certainty and convincing evidence? Do you believe that whatever deferred tax asset you have recognized or you want to recognize it is going to be reversed in the future? If it is there, you can recognize. If it is not there, you cannot recognize. Correct. Even though on depreciation, on unabsorbed depreciation, you cannot recognize deferred tax asset if you do not believe there is a reasonable certainty and convincing evidence. Right? आप उसको set off कैसे करोगे future? So the whole thing depends on the virtual certainty and convincing evidence in case of the companies where the companies are incurring losses.
Right. Thank you, sir. I hope this clarifies. The second question is traveling expenses reimbursed to executive director for business travel of the company. Is disclosure needed as per Ind AS 18?
I think you are talking about related party disclosure. So in related party disclosure, it is not Ind AS 18, it is AS 18. In Ind AS, it is Ind AS 24, right? So if there is a reimbursement for the business expenses, I believe it is not a related party disclosure.
Okay. And the last question that has come is payment to statutory auditor for certification of Form 3CEB should be clubbed under audit fees in the P&L statement or shown under other heads.
See, if it is a payment to the statutory auditor, there is a requirement of Schedule 3, which classifies these expenses to payment of auditor in the capacity of, statutory auditor as a statutory audit fee, as a tax audit fees, as a other matters, right? So it is not a statutory audit fee. It has to be shown in the other heads. Okay.
Okay. Yeah. Thank you so
Any
much,
other
sir.
Thank
question?
you.
That's
So just one disclaimer before we should conclude this session. So these are, of course, my views. These are not the views of AASB of ICAI. These are the faculty's views. Okay, and this is my personal views. So it should not be construed as a views of any regulator or any AASB of ICAI. Right. Thank you.
So thank you so much, sir, for your deliberation. On behalf of AASB of ICA, once again, I extend my heartiest thanks towards you for sparing your valuable time and sharing your insights with all our members. Thank you so much, sir, for your wonderful deliberation. Thank you so much, Anchal Madam, for wonderfully coordinating the webinar. I also thanks all the participants of today's webinar. Thank you. Thank you so much. Namaste.
Thank
thank
you,
you,
Thank you,
sir.
Anilji.
sir.
Thank
Namaste.
you, Anjalji.
Thank
Thank
you,
you.
sir. Thank you, sir.
Thank you, sir.